Hi, this is Daniel, and you're watching Unrivaled Investing. But beware, Unrivaled Investing is a no hype zone. We are just focused on the fundamentals, trying to figure out what can fundamentally drive a stock price higher in the future. What should it be worth in the years ahead? We're focused on things like what's the addressable market? What are their margins? What's their growth potential? So that way we can realistically pencil out future returns. Today, we are talking about Forum Merger Corp 2. It's a SPAC. They're merging with Tattooed Chef, the Tattooed Chef. So the SPAC, the ticker is FMCI. Tattooed Chef is going to be TTCF. What's Tattooed Chef's business model? Because at the end of the day, Tattooed Chef is going to be the one that drives your value as shareholders, going forward. So we want to understand what it is about Tattooed Chef. Like, what do they do? What's their business model? What do their financials look like? Do they have an unrivaled value proposition? That is a key filter I look at for all companies. It set aside whether or not you're rivaled or unrivaled. If you're unrivaled, it means no one else really competes as well as you on this given niche. And if you're the top dog in the niche, then it gives you the right to win longer term. But if you're rivaled, that means you're competing with a bunch of people, and it's less clear, like, how do you perform over time? Do you have, so that's unrivaled value proposition. Is there a big 10x opportunity? At the end of the day, I'm looking for big game, baby. I'm looking for lots of upside for stocks that I could potentially hold for years, if not decades. And the reality is, you need to be tapping into a much bigger market, be tapping into a much bigger opportunity in order to get juicy returns over time. If you're tapping into a small market, or you're already dominating that market, there may not be that much potential for you in the years ahead. And then lastly, my value proposition to you is I also have a free investment calculator for my loyal YouTube subscribers. You get to the end of the video, I'll show you where it's at. But before digging in, if you enjoy learning about multi-baggers, potential stocks that can go up hundreds or even thousands of percent, make sure you subscribe to this channel. If you're already a subscriber, thumbs up would be appreciated. Also, if you want to learn what I'm personally doing, go to unrivaledinvesting.com, click on that journey button. And the reality is, the secret in finance is that you don't need to find that many multi-baggers in your life to potentially change your life journey. So if you want to follow my journey to find these potential multi-baggers, just go to unrivaledinvesting.com, click on journey. That's what I'm focused on here. Also, I love it when you post questions. A lot of these videos are because you're asking me like, hey Daniel, I'd love to hear the unrivaled investing take on this company, this space. And I'm making it happen one by one. We're knocking it off. So Tattooed Chef, ticker FMCI for now, TTCF for the future. This is because of you, my loyal YouTube subscribers, my loyal Journey subscribers that have asked. Several folks have asked. So that's the reason why I'm doing this. So leave the next company that I'm supposed to be looking at in the comments below, and let's dig in. So what is FMCI? So that's Forum Merger 2 Corp. It's a SPAC. Like, let's do the when, what, where, why type of thing. When we're in the middle of a SPAC craze, where part of the reason why is there's exuberance to own stocks right now. Like, this is, there's two times, there's two ends of the spectrum. There's like buy and sell. And right now we're closer to the buy phase, where everyone's like, yes, this company has no revenues but a lot of potential. Let's throw on a multi-billion-dollar valuation. We're in the middle of a SPAC craze where it's pretty easy for companies to go public. SPACs are effectively big piles of cash, holding hundreds of millions of dollars, sometimes even billions of dollars, where they're looking for a company to merge with. It's a lot easier. So that's the when. So the what is this pile of cash, which is a SPAC or a special acquisition company. It's looking for a deal. Part of the reason why they look for a deal is because the founders of the SPAC get special founders shares that really don't cost them anything. So if they find a deal, then they get part of a company effectively for free. If they don't find a deal, then they have to return the cash. So I think you can figure out what the incentives are. And then what are the pros and the cons? The pros is that it's a lot easier for companies to raise funds. It's a lot easier for a company to go public because you just have this one gatekeeper, effectively, like whoever's running the SPAC they know effectively what their shareholder base is and who's going to approve. And so that's the pro. This is super high level. I've actually done more detail on SPAC in some of these other videos that I've done. The cons are that with fewer gatekeepers to bring the money or bring these companies public, it's much easier to bring crappy companies public. And so you really have to have a discerning eye to figure out, like, hey, is this a crappy company or does this company have legs? Does this company have potential? Would I want to partner with it? And the reality is, some companies are worth getting in on the SPAC stage even before the SPAC merger is completed, because it's almost like special investing or special situation investing, because sometimes the information hasn't fully spilled out to the marketplace, so that there's this opportunity, like, oh man, there's an opportunity here. And folks that subscribed to Unrivaled Investing Journey know that I've talked about at least one SPAC that I've personally bought for my personal portfolio. And you can see here's a bunch of other SPACs that I've recently done. Chamath Palihapitiya, he's going SPAC IPO-A through IPO-Z, and you can see some of the recent ones with IPO-B, IPO-C. There's Multiplan, there's Desktop Metal. So I've got you covered. I'm going one by one through them if you're interested. So let's go into Forum Merger Corp 2, which is a SPAC merging with Tattooed Chef, TTCF. So that will be the ticker after the merger is complete, after the deal is complete. And relative to some other deals I've seen, this is actually a fairly simple structure. 207 million in cash coming in, 75 million going to existing shareholders. So effectively, the founders want to get a payday. And then you see 39 million expenses. That's actually really high as a percentage. Like, keep in mind, this deal's only $207 million in cash and like 39 million. So you're saying like 20% deal expenses. That's that's a lot. So then they're paying off some debt, and then 90 million is going to the balance sheet. So really, like, as a SPAC founder, like, it's a simple deal terms, but kind of ugly in terms of how the capital is getting distributed. Like 20% is going to fees and expenses to make sure the deal closes, which is pretty rich. Really, only 90 million is going to the company itself to make the company better. The rest is going to pay off the existing shareholders. And look, like, the founders, maybe they deserve that $75 million payday. We'll get into that in a second. It's worth pointing out, like, here, Forum 2 management, they're getting 5% of the shares approximately. And this is what the shareholders look like afterward. Public shareholders, that's the existing shareholders in FMCI. This Forum 2 management, this is the gift that I was sort of talking about a minute ago that SPAC founders get. Usually there's some sort of exercise price at, like, hey, you can get 5% of this company for $25,000. It's something like that. And that gives them the incentive to do the deal. So, I know in some of the past videos, like, everyone's like, wait a second, Chamath said he's not charging any fee on IPO-C or IPO-B. Like, there's no fee. Yes, no fee. He's not getting this fee. This is the banker's fee. But he is getting the X percent in IPO-B or IPO-C just for being the SPAC founder. And in that way itself, that's a multi-million-dollar payday, tens of millions of dollar payday. And, yes, they usually own some of the public shares as well, but this is the gift part, just for clarity for people to think about. Okay, so what is Tattooed Chef, ticker TTCF? That will be the ticker. Right now it's FMCI. So Tattooed Chef, the story, it's a father and daughter story. Like, I love it. I love hearing this, where you have Sam Galletti. He opens Stonegate Foods and begins importing vegetables and other Italian products to be sold to national natural channel retailer. And you can see that this is around 2009, slowly but surely. Like, this guy, like, successfully grew a company from a few $1,000,000 in sales to nearly $10 million in sales when his daughter, Sarah Galletti, joins as the creative director. They sort of pivot the company, and I need to pause a second, because there's a couple of important data points like to conclude from this. First, seeing a father and daughter working together, like, it's automatically heartwarming, but in my mind, you need to think from a probabilistic perspective, in that this increases the odds that this company is about a missionary zeal. It's not about a bunch of mercenaries looking to squeeze margins or how do we make the most dollars. It's like, hey, how do we make products that resonate with people? I also feel like it's less probable. I'm not saying it's certain, but I'm saying it's less probable that you get screwed over as a potential shareholder when you see a father and daughter working together. You're less likely, I would suspect, to have fraud. Because if you have fraud and it's father-daughter, you sort of soil your entire family. So these are just data points that I'm thinking about. I'm not saying definitively, but I'm saying it increases the odds of these things, make it slightly more favorable. And I also like to see, like, little by little they've been adapting to what works. So you have Sam, and he started off with importing vegetables. Then Sarah joined several years later. He's already made his mark, growing his company to 10 million in revenue. And then they start figuring out, you know what? Maybe we should focus on plant-based food products. And that's really the push that she brings on as this creative director in the company, thinking like, what should we be selling? And that's when things really start taking off. So she joins in 2014. The next year they grow by 20%, and then they triple by the time it's 2017. And now they're penciling out nearly 150 million in sales as they've continually launched new products and expanded capacity. So, what exactly do they sell here? Like, what is it? What's their value proposition? What are they selling? And their products are all these plant-based meals, or treats that you can get. And so, for example, they have this cauliflower crust cheese pizza, buffalo cauliflower burger, and these are all under the Tattooed Chef brands. These acai bowls, organic zucchini spirals. So, the takeaway when I'm looking at this, and they also have this pie chart here that shows like meals is 35%, smoothies and bowls is 20%. So it's interesting. Like, meals and smoothie bowls, which is these acai bowls, that's over 50% of their business. And like pizza, and I don't think any other pizzas other than this cauliflower. So like cauliflower pizzas, 13% of the business. When I see this, like, it lowers the risk of the business for me as a potential investor, because I'm thinking your product lineup is more diversified. And it also makes me think you're doing a good job. Like, this is not a one hit wonder type of company. They're figuring out this niche. They're figuring out this brand that's potentially resonating with a lot of people. And it looks kind of cool. If to be on 100% honest, I'm a little bit more of a steak and potatoes sort of guy. Maybe fry up those potatoes and fry up that steak. But I understand a lot of people like buffalo cauliflower burgers, and if that's what does it for them, that's great. So I like seeing this. I like seeing they've effectively diversified their revenue streams. They half of their business is their own branded stuff. The other half is private label, aka they're making stuff for the folks that are selling it. So let's say Whole Foods puts their own label, like, "Hey, this is the Whole Foods cauliflower pizza. It was really made by Tattooed Chef," or here's the Trader Joe's product. It's really made by Tattooed Chef, but it's you don't see the Tattooed Chef brand. I would expect more and more Tattooed Chef branding in the years ahead. But what's the really important takeaway if you're looking at this is that if you're seeing all these different products and you're seeing a relatively diversified just over the last few years. I mean, keep in mind, you know, this really only started. The Tattooed Chef brand was only launched in 2017. So if you're thinking like just in a couple of years they've really gotten all this stuff out, it makes you think their growth might have legs to it. It might have, increases the odds that their growth could be sustaining, that they'll launch even more cool products that resonate in the marketplace in the years ahead. And so that's sort of why they pencil out like, oh yeah, we launched the Sahi Bowl under the Tattooed Chef brand, and in the first month it did 200,000 in sales, but by month 12 it was a $9 million revenue product. Like, this is pretty incredible. Here it is. They did their rice cauliflower, and these are both for the Tattooed Chef brand, and they did the private label. And you can see like both of them, they just crushed it, millions of dollars just within their first year. It's obviously possible to manipulate these figures, or it's like, hey, we launched here, but then it opened up in all these different stores, and we weren't open at these stores when we initially launched. And if you start off in one Whole Food store and then you're in 10 Whole Food stores, it's much easier to show figures like that. But I suspect they're trying to make an apples to apples comparison of like, yeah, these products really do get market traction. We do have product market fit. So this is overall exciting to see. The Tattooed Chef, Sarah Galletti, like she she might have a real, maybe, sixth sense for figuring out like what are the products we need to bring to market. So there is, like, when you think about that, there is some potential like key man risk of like, hey, what if she walks away? Because if she's the brains behind creating some of these things, you don't want her just walking out. If she's the tattooed chef, but let's get it. We'll get into that in a second. The $1 billion question remains, however, do they have an unrivaled value proposition? And that's the key filter I use for all companies. And I suspect for the tattooed chef, it's either strong or unrivaled. And that may seem surprising, especially for a food products company where you're effectively competing with all these other brands on the shelf. But I think they're purposely creating this brand that's edgy, healthy, and good for the world. I love seeing this growing and making plant-based foods for people who give a crop. Like I love this sort of branding that they're doing. It's beautiful. It pops. It resonates with a lot of people. Like, yeah, I don't want to make the world a better place by eating this corn dog. Like maybe maybe this Kraft mac and cheese is gonna give me cancer. Like, and there were articles about that sort of stuff like a few years ago. Maybe I should eat this cauliflower mac and cheese bowl where it seems a lot healthier and maybe it's better for the earth. Like I like this branding. I like that it's slightly edgy, like people who give a crop. But is it unrivaled? Like let's dig into why potentially it's strong or unrivaled. So first, like the problem that they're solving is easy pre-made meals of plant-based food. So easy pre-made meals of plant-based food. And I think they're tapping into something that's actually really not that well flushed out yet. It's not fully understood yet by the marketplace. And the reason why I say that is if I go to Google, and you can do this right now, and I type in plant-based meal brand, what I get is a bunch of things like this: Before the Butcher, Beyond Meat, Morningstar Farms, Gardein, Tofurkey, and it's the article is about vegan meat replacements. I wasn't looking for vegan meat replacements. See what this is the reason why I think this is a niche or a niche that's developing that people aren't really thinking about. And it's not just replacing meat. It's not someone saying like, "Oh man, I love steak and I need to go eat some steak replacement." That's not it. This is a way of life for some people. This is not a substitution. This is they're choosing to do this. Like for me, it would be a substitution. Like I just love a good steak. But I think there are a lot of people that are like, yeah, this is the way I want to live. I like this cleaner life. It's not about substitutions. This is their preferred way. Um, and so just the fact that Google, when I searched it, does not show up like, hey, this is a core category, plant-based meals that are sustaining and delicious. But it's instead saying like, hey, these are the substitute products that you're looking for. It shows that this hasn't really fleshed out yet. It hasn't really built out yet. What else is going on? So, when you're looking at niche products, it's inherently less competition. Like, how many cauliflower pizza brands are you going to see competing on the shelf? Like when you have these very unique products, I don't think you're going to have 5, 10 different competitors. Maybe you have one or two. If you have one other competitor, but you have this sexy, edgy brand, you're probably going to go with the brand you trust. Like, I just don't see there being 3 different cauliflower pizza brands that are going to compete with you. So less competition, and that's sort of a question mark. I suspect there will be less competition. Equals higher margins over time, equals potential for growth, higher growth. And then the question of like missionary zeal, and I loved reading here's what Sarah Galletti had to say. Yes, there is a tattooed chef behind every product. I create and formulate the items that go out onto the shelves, and I love creating new concepts every day. It's important to not only have an idea, but to conceptualize how that idea translates correctly in production. One of the key components to creating a successful product is staying true to my vision and making food I want to create. If I don't believe in a product, I won't make it. In maintaining this mindset, the consumer senses our belief in our product that we put out into the market. This is like, this is, does this have missionary zeal? Like, I would rather align myself with a missionary than a mercenary. And in hearing how she's talking, like, I'm not going to put out products that I don't trust, like that don't resonate with me. That's what she's saying. And keep in mind, there's a little bit of background if you go to the website where she says like she saw the tattooed chef as like a vision in a dream that she had one night, and she's like, okay, this is what I'm doing. And this was after she traveled abroad and she came back home. So like I'm excited about it. Maybe this is all just spin, the whole like in a dream, but it sounds like to me that this is missionary zeal. Like that she's going to be like, I'm going to come up with these things that are authentic and that it's really going to resonate. She's saying the consumer is extremely smart and perceptive. They know if something is vibrant or not. That vibrancy is the tattooed chef. Um, and then I'm incredibly proud of how we're able to rapidly introduce new and innovative products. I think she's able to do that because she's staying true to herself. It's an authentic brand. And people love authenticity. People love to buy into authenticity. She's saying it's an understanding of consumer lifestyle and food trends. Our commitment to innovation allows us to continuously introduce highly successful new products. So if you're continuously launching new authentic products, that sort of does give you that growth runway that gets investors excited in the years ahead. Like who knows what new major hits they could launch in the years ahead. Um, it's also, like confirming this missionary zeal aspect. Here's also on their website where they talk about how it's true farm to table. We plant and manufacture all our own products. And say when we say we're farm to table, we really mean it. Most of our ingredients come from Italy, where we contract the fields and plant our own crops. Now, like keep in mind, farming is a very low return on investment venture. It's a commodity business. It would be cheaper for them, like if you're a company based in California, it'd be cheaper for them just to say, hey, we're going to buy the cauliflower from these other fields nearby versus the ones that we own, the ones that, or the fields that we contract with. Like, so for them not to capitalize on the fact that they're buying products that are commodities, but they want to grow it themselves, like this reflects missionary zeal. They want it done right. They want it done cleanly in a sustainable way from the very beginning all the way to you buying it from the grocery shelf, microwaving it, and eating a delicious product. Um, and when I think the reason why missionary zeal is so important is when you think about a behemoth like Kraft, um, I think a missionary is going to run circles around a big behemoth like Kraft. Like if Kraft wanted to compete with them, yeah, they'd be able to come up with their own products, but it's not going to. They'll at best they would be a fast cloner of what they're doing. And I personally, I would be more excited to own the missionaries than bet on the mercenaries. What about opportunity? Like, does this have 10x opportunity? And they're penciling out nearly 150 million in revenue in 2020. The reality is they're tapping into a market that's hundreds of billions of dollars. So the 10x opportunity just strikes me as yes, it's fairly obvious. And they're saying like, look, not only are we tapping into like the vegetarian diet market is hundreds of billions plus, we're also plant-based diets, no artificial ingredients, all natural, organic, non-GMO, clean label. All these things, like many of them resonate very strongly with Tattooed Chef. So I would say that the 10x opportunity is a clear check. Like this definitely makes sense. The value proposition, like you could argue with me, like yeah, it's just a matter of time before someone just crushes them. And that is possible. I mean, that's where the portfolio management and what size position is you want to think about. But are you betting on a bunch of missionary with missionary zeal? Yeah, I think so. And it's exciting. Like as a shareholder, it must be exciting to be on that path to see what new products they're going to launch. Is there actually a clear path to tapping this growth? This tens of billions of dollars of growth potential, is there a clear path? And the answer is yeah. It is actually fairly clear. Like when you're launching new grocery store products, there's actually a much clearer path than let's say with something like with pure e-commerce, because you can see what stores, what grocery stores you're currently in, and they're like, oh yeah, here's the light blue bars are the ones they're currently in, and there's the number of store chains, and they're only in this many of this total of the mass merchant, and they're like, yeah, all these dark blue with all these stores, we haven't tapped that yet. We're going to though. And so when they're like, yeah, we're going to roll this out, and we're already successful in Whole Foods, and we're in Sam's Club, and things like that, I would think it's more probable that you do successfully roll out in many of these regional grocery store or the larger grocery, maybe Target starts carrying them, things like that. It becomes an easier sale where you're like, oh yeah, we're with Whole Foods, we're doing this with this dollar business. Target, you don't want to. Safeway, you don't want to. So like that becomes an easier sale it becomes much easier for them to grow. And with $150 million in revenue, all it takes is unlocking a few of these big boxes, a few of these big channels, for them to really tap into that growth and grow exponentially. What about the thoughts on the risk reward from here? And this is the valuation, my thought process based on how the deal was done at $10 a share. And it's around 60 million shares outstanding. The deal was structured at $10 a share, and that's where foreign merger, 2 or foreign merger 2 FMCI, it IPO'd at $10. So you have this $10, 60 million shares, 600 million valuation. And you could see 85 million in revenue last year. They're penciling out, I think, closer to 148 million, but they recently reported third quarter revenue that was slightly below 74%. So I'm showing a range of 70 to 74% growth. This is for hypothetical. This is a hypothetical range. And keep in mind, this is my value proposition to you. I'm trying to create an unrivaled value proposition for you. And if you go to the link below the description of this video, you can play around with the assumptions yourself. So if you disagree with anything here, change it. Download the sheet and change it. And the whole point is that I'm creating a range of assumptions so that way you can see a logical framework of where the stock price can go. Could it go way higher or way lower? Absolutely. But the point is, I'm trying to pencil out a logical framework for what it could. Like, will animal spirits push it higher in the short term? Potentially. Will animal spirits push it dramatically lower? Potentially. I'm just trying to figure out what's a logical framework for how to think about these things. And so you can see what the growth is for 2020. This is based on what they've sort of guided to. So, somewhere around 150 million. What's the optimized margin? And here they've actually done us a solid of saying, like, hey, look, here are all these different companies that are sort of comparable to us, and you can see what their EBITDA margins are. EBITDA is a very rough proxy of free cash flow. It's extremely rough. I can do a separate video for Journey subscribers that want to learn more. So I'm using optimized margins. This in case is operating profit, which is after depreciation and amortization, which this is before. Nevertheless, like you can see that the median is 14%, the median's 19% here. Like here's Hostess. I think it's sort of funny to compare this ultra healthy, plant-based company to Hostess, which I don't think those products ever expire. Still taste delicious. Um, Problem is you are what you eat, right? I don't want to turn into a Twinkie. So I'd much rather be a cauliflower pizza. Doesn't that just like radiant like energy? And so when I'm looking at this, I'm thinking, yeah, the margin profile for this business is probably somewhere between 10 and 20%. That's a pretty wide range. Like maybe you could say definitively 10 to 15 or 15 to 20. That's up to you to pencil out. But I like doing a wide range just to start thinking about. And this is an initial take. As I learn more about a company, I might refine it and say, you know what, let's tighten that up. 2% off the top, 2% off the bottom sort of thing. And so you could see like what sort of slap on a tax rate of 25%. And you can see based on this deal term of at $10 a share, they're paying somewhere for a hypothetical earnings of 27 times to 55 times for a company growing at 70% plus. That actually strikes me as an attractive deal. Like they're paying a very reasonable multiple for this company that's growing very quickly. They think they can grow another 50% next year. Who knows what the growth rate is over 5 years? And so, here it is. I'm penciling out a growth rate over the next 5 years. This 15%, honestly, is probably too low. But I just wanted to throw that one out there. You could pencil out higher. I would think 15% is too low, especially if you think you're going to unlock some big box next year and you're going to be at 50% growth that next year. If you're at 50% growth in 1 year, 15% for 5 years would strike me as super low. Anywho, I'm throwing out a range of options for you to pencil out, and throwing out an assumed multiple of 20 to 30 times. That's keep in mind that's a multiple for 5 years from now. That's not for today. That's where this business could be. I'm trying to use some sort of logical framework 5 years from now. And you'd see based on the deal that it's, pretty limited downside of 20, 30% versus upside of like 400%. If you think like a 30 times multiple, if people are really gung ho about their business prospects and their growth opportunities, maybe they launched this new acai bowl and it has something really magical in it, and growths are going like crazy. Growth is going nuts. Like maybe 30 times multiple is appropriate 5 years hence. And like that's an attractive risk reward. And so I would say, like, good job Forum, SPAC managers. Like you guys seem like you penciled out a good risk reward, getting a good deal. But keep in mind, this is based on the price in which they did the deal. This is based on the folks that bought in at $10 a share. In every company, the risk reward changes based on the new price of the shares. And so, like, the problem is now the stock's trading at $24. The deal hasn't closed yet. It probably will, is my suspicion. And now it's at $24. So, like, $24 versus IPO of 10. Like, people suspect this is a great deal. Like, this is a great company. This company has legs. That is is what investors suspect. And they think there's a tremendous amount of opportunity. But the problem is that not all great companies are great investments at any price. Like at some prices, great companies are actually not that great investment. And so it's there's a dynamic trade-off where, as more and more people know you're looking at a great company, the lower the return is going to be because people continue to bid it up. So that's the tough part about investing, is that it's a dynamic process. The more people that know you're dealing with a great potential company, or a company with a lot of great potential, the lower your potential returns will be because they're bidding the stock up. And so, I've penciled out returns from here, and, like, based on $24 a share, which is $1,400, $1.4 billion valuation versus $600 million valuation, your return is, and once again, same assumptions, the 10 to 20% margins, 15 to 35% growth rate, the risk reward isn't nearly as compelling, where it's 70% downside versus 100% plus upside over the next 5 years. So it seems like a lot of people are aware this could be a great company, but your returns might be muted versus, like, if you bought at $10 a share, I'd say congratulations. Like, management did a good job finding an attractive deal, and you're sitting on some nice returns. At this point, I'm not super, like, at $24 a share, the risk reward isn't as compelling. I prefer, like, what I buy with my portfolio. Journey subscribers will know this firsthand. I've made some videos about this. Is that I prefer to find things where the risk reward's a little more attractive, where the upside downside, like maybe heads I win because it goes up a couple of 100%, tails I don't lose much, like maybe I lose 20%. And so when I'm looking at situations like that, then I'm more inclined to make a bet. And keep in mind, that's based on these sorts of hypothetical valuation frameworks. Could it go way lower, way higher? Of course, but it needs to be based on a foundation of logic. What I suspect happens here is that one of the major brands just look at them and they're like, this company is a thorn in our side. They are crushing it. How come our growth is closer to zero? You know what? Let's acquire them and we'll get their growth. And I suspect that within a couple of years after the merger goes through, that they're just acquired. That's what I would expect happens. Like, I don't think they become the next behemoth. It's possible, but I think one of the major brands goes, you know what? They're tapping into this niche. We didn't do a good job. Our sales and marketing team, they were mercenaries. They weren't able to truly come across as having an authentic product, but they did. So let's just buy them. And at that point, you get your premium as a shareholder. The question is it going to be significantly more than $24 a share? And to that point, this is the challenge that I have for existing shareholders in FMCI and the Tattooed Chef, is, like, at the very end of their presentation, they call out, like, hey, our management, the CFO, this co-CEO, CFO of the Spac, Forum Merger 2, they did Forum Merger 1, which merged with Converge 1, and they're like, look, this was a good deal, and he has experience with approximately 20 other SPAC transactions. And so, if he's had experience with 20 other SPAC transactions, then I'm thinking there are 20 other deals that you could call out. But this is the one you call out. So this is probably going to be the best one that you call out, because you've experienced with 20 other deals. This is what I'm thinking. I mean, you could say, well, this is the first one that he did with Forum, so the other 19 you shouldn't think about, but let's keep going. Like, this might be one of the best deals he's ever. So he does this deal with Converge One. He says it's a leading IT services provider, yada, yada, yada. And let's jump to the conclusion. And what ends up happening is, you can see in the bottom left of the screen, Converge One was acquired for 1.8 billion by CVC Capital 9 months after the merger. Okay, so once the SPAC deal completed, so this was their first SPAC, FMCI is their second SPAC. And so 9 months after the merger, they were acquired for $12.50 per share, netting a return of 43.5% to investors who purchased units in Form 1's IPO. The reason why this is alarming is because, first of all, it's clearly there's sort of this mercenary aspect of like, hey, we got it at this price, and then we got a 40% return in less than a year. Woohoo! I'm not turned on by a 40% return in 1 year. Like, I want to. That's great. Don't get me wrong. Like, most people are like, yes, I locked it in. I'd rather find those multi-baggers, things that you can sit on for years or decades that are just compounding at 20-30% a year, and you get a great return. I'd rather get something that's 10x. Journey subscribers know I have several multi-baggers in my portfolio, where I'd rather find something that can compound for long term versus this mercenary approach of like, yes, let's just find someone who's going to pay more, and get this deal. And the second aspect is, if like right now the share price is $24, which is this huge premium versus the $10 IPO, and their benchmark is the $10 level. So if they, let's say, close a deal in the next few months at $20 a share, like, they'll do future posts where they're like, yes, and we netted a 100% return for the investors that did this at IPO, and that allows them to succeed, because they're like, look, if you invest with us, if you that enables them to do future SPACs. You invest with us at the $10 a share, and you'll get a great return. The problem is, anyone else that's been buying since the merger was announced, anyone that's like, oh, this is a great company, I want to buy it, and it's now at $20 a share, $24 a share, there's a chance you actually lose your shirt, because they're like, oh yeah, let's just lock this up at $18 a share or $20 a share within a few months. So that's sort of the complex, risk reward here. Like, I don't like the fact that they're focusing on what was the IPO price, like, of $10 a share versus netting out and selling for 12.50. Like, if Tattooed Chef sold for 12.50 in a year from now, I'm telling you, like, a lot of existing shareholders would be very disappointed. So that's just something to think about. When you consider, like, what are their incentives? Their incentive is to pencil out how they did relative to that $10 share price, and maybe sell it sooner rather than later, so that way they can move on to their next SPAC and get at 5% of their next deal. So there is a little bit of conflict there. Just something to think about. I'm not particularly excited about the risk reward at current share prices. I put the calculator for you to think about, like, hey, what's the risk reward that you want to consider for your own portfolio allocation. But if you want to see what I am doing, you go to unrivaledinvesting.com, click on Journey. There's exclusive content. You can see a monthly download of my portfolio, what I'm buying, what I'm selling, what I'm holding. You can't take these shares away from me. With the exclusive content, not only do I call out some stocks that I'm buying, I'm trying to teach you how to fish, where I'm sort of sharing, like, hey, here's how I think about finding multi-baggers. Here's one type of setup. So I recently did a video like that. And once again, finding just one potential multi-bagger can change your life journey. So if you're interested in following my journey as I try to find these multi-baggers, you go to unrivaledinvesting.com, click on Journey. And if you enjoyed this video, please make sure you subscribe. And if you're already a subscriber, hit that thumbs up. Thank you so much for watching.